Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to the third and final session on the series of impairment, wherein in the first we talked about the basic and the formula part of the impairment between US GAAP and IFRS. Then we talked about the analytical aspects and a special category which is long-lived assets held for sale. Then here in the third category, I am talking about only and only the examples. So it is absolutely imperative to look at both of these sessions to understand the concept in detail, only after which we will be able to understand these examples. So moving on to the first practice example, here we need to calculate the impairment loss under US GAAP and IFRS. You would quickly recall that in case of IFRS, my impairment was a single step procedure where the net book value was being compared with the recoverable value, which was greater of the discounted cash flows, the value in use, or the other option was the fair market value, the amount we are going to get by selling it. So let's try and put in some figures here. It says that 220 is the original cost and the accumulated depreciation is 30. So to speak, my net book value becomes 190,000. This is the benefit which the business expects from the asset in future, which needs to be marked to market, so to speak. And in this case, you have the discounted cash flow being 140,000, which is value in use. So the question has original cost, accumulated depreciation, undiscounted expected future cash flows, fair value, selling cost, and value in use. Now the fair market value needs to be taken care very carefully. 170 is not the fair market value, it is the gross value, which needs to be reduced by the selling cost to bring the fair market value to 135. So higher of the two clearly is 1,40,000, and the impairment loss under IFRS is equal to $50,000. Well, if I look at the US GAAP, which has two-step procedure, in step 1 I am just going to check. So for checking, I am going to compare the net book value with the undiscounted cash flows. So here my undiscounted cash flows is 160 and my net book value is 190. So the bad news is confirmed. Yes, my assets are impaired. Once there, I need to calculate the impairment loss by comparing the net book value with the fair market value if available. If not, I always have a backup plan of discounted cash flows to be used only as a backup. So therefore, the net book value is 190,000 and the fair market value is 135, which I have already calculated for IFRS. So therefore 55,000 is the impairment loss under the US GAAP. So you can clearly see that the answers under US GAAP and IFRS are different. Okay, moving on to the next example, which is got a similar construct, the same parameters almost being given, just that the values are a little different. So jumping on to the IFRS, my net book value is 220 minus 90, it is 130,000 minus the recoverable amount, which is greater of the value in use right here 140 and your 135 fair market value, so which is greater of the two is 140. The answer is negative 10,000. Obviously there can't be a negative loss. It basically says that the assets are not being impaired. Now that's the point where US GAAP scores better over IFRS because US GAAP, before actually performing the operation, first checks the medical condition and only then admits the patient, so to speak. So here IFRS directly performs the operation, opens the heart and find out, oh I'm so sorry, your heart is already working fine. So short point is, as a doctor, you got to really make a check before directly opening the heart of someone. But that's the way IFRS functions. Let's try and understand how US GAAP is going to do. So US GAAP is going to first look at the electrocardiogram of the patient by saying your net book value needs to be compared with the undiscounted cash flows, which are 160. If the undiscounted cash flows are more, that means you're absolutely a fit man. There's no need for impairment. You will not go to step 2 of US GAAP. So, like I said, in conditions like these, you're going to really feel that US GAAP performs much better than the IFRS. So the answer is, in both the cases, there is zero impairment loss. Let's look at the third and an application-oriented example for impairment, wherein the book value of the asset, which is the written down value, is 12,000, which was impaired by 2 grants at the end of the year, which means A is equal to L plus C, 2 assets down, and your profit and loss account goes down by 2, which is on 31st of December first year. Next year there was a revival. Therefore, the moment you look at the word revival, reversal is something that should cross your mind, which leads to the value of the market value of the asset going to 13. Question is, how much is the impairment loss in year 1? That's my answer of the first part. The second question is, what should be the impact in the second year on the financial statements? So basically, you are aware that reversal has dealt differently under US GAAP and IFRS. My IFRS allows reversal, my US GAAP does not. So therefore, to answer the second question, US GAAP, the financial statements are not impacted at all. However, under the IFRS, now you got to understand that an asset which was 12 went down to 10, a loss of 2, and the market value is up 13. So actually I want to raise it up by 3, but what is the maximum potential available for reversal? Remember, under IFRS we said you can reverse the impairment only up to the amount written down earlier. So you want to increase 3, limited by the potential of 2. So your 10 will again become equal to 12. So A is equal to L plus C in the second year is your asset will go up by 2 only, and your P&L account will go up by 2 only. Okay, so this is a key point here, that the reversal, I want to reverse it or jack it up by 3, but I'm limited by the maximum potential of 2, which is the written down portion. The third, and again an application oriented example, we are talking about the pre-tax income. That means something to do with the income taxes. Now, a little bit of understanding of income taxes is also critical, but I'm sure that by common sense we can get to that level without looking at the videos of income taxes. Pre-tax income, ignoring the impairment loss, was 400,000 during the year. That means your profit before tax, as per the rules of financial reporting, is 400,000. Okay, and there was no difference between the taxable income as per the income tax authorities and the rules of financial reporting so far. That means, as per the rules of IT as well, so far both of us are moving in the same direction. Now, for people who haven't done income taxes so far, let me tell you, one, there is a specific video recorded on income tax, so please look at that on the same channel. The second part that I need to tell you is that the income tax authority have different rules for charging taxes, which are a little different than the rules of financial reporting. They sometimes disallow a particular expense, or sometimes extra allow a particular expense, depending on their specific rules. So in this case, one of the practical aspect is that income taxes do not allow impairment loss as a deduction. So while my accountant would have reduced his income by 40,000 to make it 3.6 lakh or $360,000, and wants to pay tax on this, my income tax authority would not agree. They don't recognize impairment loss. So therefore, according to the income tax, your taxable income remains at 400,000, and the current tax, which is the tax to be paid to the government, will be 400,000 multiplied by 40%, 160. Whereas ideally, I would have wanted to pay a much lower tax on 360,000, but the rules of the income tax is that we do not recognize the impairment loss. So the answer to the question is the 160,000 shall be the current tax going forward. So I hope that these four examples have been useful in cementing your understanding for impairment. There is a lot more to offer in different modules, different topics. Should you have any question, query, or want us to take a particular topic, please feel absolutely free to write to finstudyclub@gmail.com. To subscribe to our channel, please log on to the YouTube and get to there. There is a lot more videos and a lot more clarity coming up. This was Ankur Kulshrestha signing off for now. Looking forward to speak to you in my next session. Thank you very much.